Okay, well, we're letting Matt get set up here. Just remember, if you got any questions, please use the chat feature, and we'll see if we can answer those. And again, we'll be taking questions at the end of the presentation as well. Matt?
Thanks, Tom. Thanks, Jeff. So now that we've talked about performance, what we're going to do is take a what we call a preliminary look at the fourth quarter 2011 fund flows again. Why we call this preliminary is we do have even though we have the majority of data in for December, there are some fund families out there that have yet to report their December month end. So let me take a look at this next slide here. All right, so what we're going to do is kind of just start off with mutual funds. This is going to be ex-ETF. And really what it was is it was an interesting quarter, especially when you compare it to what we've seen in performance. Overall for Q4, we saw about $56.6 billion come into the conventional mutual fund business. This is the only quarter thus far, 2011, where we saw positive inflows. And as you can see, and we'll talk about it a little bit more, it really came on the shoulder of such real positive flows into money market funds. But across the board, I included all four quarters to give us kind of not only a look at what the most recent quarter done, but kind of a retrospective look at the year. And the real theme I think that Tom had mentioned and what we'll continue to talk about is U.S. diversified equity. They've really had a struggled year. For the quarter, U.S. diversified equity pushed out about $73 billion. And again, this is on the shoulders of what Tom had pointed out is about 10.8% of positive returns. So even though, again, we've seen good returns in the market, really some investors are just not convinced. They're continuing to pull assets out of that group. For the year, U.S. diversified equity has pulled out about $161 billion thus far. Sector equity over the last three quarters has been relatively flat. This quarter, we saw about $2.5 billion come out, a little bit less than we saw go out last quarter. World equity, about 15.1 out, again, a little bit more than what we saw last quarter as well. For sector equity, we saw about $11 billion out, or $11 billion in for the year, and world equity about 17.1 thus far, preliminary through the end of the year. Then going to the other side, really what the big story was taxable fixed income. Continued to bring in strong inflows, $67.4 billion over the last quarter, 166 roughly for the year. We did see a little bit of a slowdown in Q3, but it came right back this quarter, coming to the end of the year, as a lot of investors, some looked to go towards take a little risk off, go towards high quality, but if we look again, high yields did very well. Municipal debt, that was kind of the big story. We all know that they really struggled, as you can see through the first quarter, not only just from a performance standpoint, but also from flows. 21.1 out the first quarter, and this quarter we see 7.8 in, so 3 consecutive quarters of positive inflows and getting a little momentum to the upside. And the last one is going to be money market funds. Thus far, through the first 3 quarters of the year, we had seen heavy outflows into out of money market funds. Quite a turnaround in Q4, $72 billion in. Still negative for the year, about 120 out. But we saw investors really come in towards the end of the year, November and December, whether it was end of the year operations or whether it was really just that point where investors felt that they were going to take to the sidelines until the year came out and maybe a little uncertainty was taken out of the market. We'll have to see how that goes going forward. Most of the time we're talking about mutual funds, but I also did want to get a look at ETFs because it really is kind of a different story out there. Traditionally, when I'm looking at flows, and it's not always the case because there are retail investors that go into ETFs, but the amount of volume and the size of the flows for ETFs really points to more shorter term trades, institutional trades, and when you compare it to ETFs, when you compare it to mutual funds, which I see as kind of more of a thermometer on the retail market, retail investors, you look at ETFs and you see a little bit more volatility and a different story. If you look at U.S. diversified equity, $18.5 billion in. That's a vast difference than the 73 that we saw out for mutual funds. And for the most part this year, they've done very well. Over the year, they've pulled in about $37 billion. Sector equity, about $2.5 billion this quarter, about 5.1 over the whole year. World equity about $1.5 billion the quarter, about $3 billion a year, and taxable fixed income, a similar story. We saw a pickup here in the fourth quarter with $11 billion in, and that group is about 15.2 so far the year. Municipal debt about 1.2 for the year, $600 million for the quarter. There's really not too much traction in the ETF market for municipals. Not too many products out there that have really gained that many assets, but they're still going towards the upside. Another look, what we'll take is the ETF flow trends, kind of just to transition to what I mentioned before on the volatility that we've seen in ETFs over the year. What this is looking at is cumulative flows. If you were with us last quarter, I put up a chart just to kind of then really look at the volatility, and it was more the day-to-day flows, but this is cumulative flows for the year. And really what we see is the big story was the S&P, the Spider S&P 500, SPY, and the volatility we saw. And again, this kind of then goes into the story of how I think that this product, especially as well as other ETFs, are really used by institutionals for short-term plays. It really kind of follows the short-term sightline in the market. You know, we saw a lot of times when we had a couple good market weeks, flows went up, and then others that went down, and it really just kind of shows to the effect and volume that creation of shares are out there in the market, and how fast the actual cumulative flows of these products can change from month to month, quarter to quarter. Some other ones to pick up on is the iShares MSCI Emerging Markets. You know, they really fell off at the beginning of the year and kind of had been moving sideways for most of the year with a little bit pickup towards the end. And at the top we see, you know, mostly positive returns, a lot of them ending in the same place, and that would be iShares MSCI EFA, PowerShares Triple Q, and then some fixed incomes as well, LQD, which is iShares Investment iBox Investment Grade Corporates, and HYG, which is the iBox High Yield Corporates. So a lot of those ended to the upside, and actually if you look at the SPY, they ended up at the same place. Really one of the bigger losers out of at least this sample group was emerging markets. But again, kind of just taking a look at how the flows for ETFs really are volatile and how they can change much more rapidly than what we're seeing in the mutual fund space. So let's move on to the equity fund flows for XETFs. Again, looking at the gainers for U.S. diversified equity, we saw equity income funds with about $6.1 billion for the quarter. This group led for this particular U.S. diversified equity every quarter this year, and actually for the year they're sitting about around $22 billion of inflows, which is really a spectacular number, and I think something we'll see going forward. Multi-cap core funds pulled in about $1.1 billion for the quarter, and long-short equity pulled in $625 million. This was the second quarter in a row that they were in the top three as well. So some investors, even though we haven't really seen the performance that we'd like to for these products, continue to go into this group probably as some kind of diversification play, trying to set themselves up or hoping to set themselves up to be able to cushion for downturns. The sector group, we saw utilities funds pulling about $765 million. Natural resources, about $289 million, which is a little bit, but not really. I don't think speaks as well to what we saw for performance this quarter, as we mentioned, about 14.8% in positive returns, and consumer goods about $50 million in. So what again you're seeing in the sector for mutual funds is kind of more towards these defensive plays, even though they are really not, the volume of inflows is not that great. It still shows a little bit of a turn for investors towards the defensive plays. Going towards the world equity group, we see emerging markets, $2.8 billion in. They were in the top three over the last 4 quarters as well, so they continue to bring in money despite their lacking in performance. I think a lot of investors are still looking to diversify their equity portion of their portfolio and still believe that emerging markets, once the turnaround goes, you'll see places like China, India, Russia, Brazil leading some of those growth characteristics. As we had talked about, Tom and I had mentioned, I think it was India, even though we saw a decrease, they're still sitting somewhere around 7% growth, and China somewhere in the 8-9%. So a lot of investors still feel that it's good to be positioned in that group. Global flexible funds also have done well. They've been in the top 3 group for the last 4 quarters when it comes to flows. This quarter they pulled in about $1.7 billion, and global multi-cap core at $760 million. So if you look at the USDE and the world, one of the groups you see is this multi-cap core play. Again, it's really kind of the go anywhere. So some investors that may not be sure, they want to be well diversified across the globe, or even domestically, kind of looking towards this multi-cap core group as their allocation. Looking at the bottom, again, we've seen a lot of similar trends, whether you're on the top or the bottom. U.S. diversified equity large cap core funds pushing out about $16.4 billion. That has been the biggest loser so far the last 4 quarters as well. It's been the top of our losers column. Actually, if you look at the year, they've roughly pushed out about $60 billion. So really struggling to garner assets. Large cap value, $5.8 billion out, and S&P 500, $5.6 billion out, and they're in the top 3 as well for the second quarter. So those groups really struggling, and it's not a big surprise because we've seen this type of trends outside of these type of products really since the downturn in 2008. Investors really had a bitter taste in their mouth, and they seem that they really haven't come back fully into this group. Sector equity funds, global natural resources for the second quarter row leads all outflows, $961 million for that group. Precious metals, which is going to be again the miners, pushed out about 802. They were down about 6% on the quarter, so they did continue to struggle. And commodities general, so this is going to be kind of your funds where it's a diversified commodities fund, $726 million out. And then down to world equity, again, many of the similar trends we've seen over the last 4 quarters. International large cap growth for the second quarter was on the bottom with $5 billion in outflows. Global large cap core about $1.3 billion out, and international multi-cap growth about 1.1. So going on to our next group, it's going to be the taxable bond funds group, and we really did see some big shifts compared to last quarter. Looking at the top of the chart, we see Lipper Intermediate Investment Grade Debt Funds pulling in about 11.4. That was compared to about 9.9 out last quarter, and Lipper High Yield, High Current Yield is about 11.3 billion in. And that was about $3 billion out last quarter, so a big turnaround. A lot of investors looking for A, quality in the intermediate space. And then also, there's some investors that are looking for high yield that's done quite well. They've gained about 5.6%, as Jeff had mentioned, in the fourth quarter. A lot of these groups, especially similar to performance, but also with flows, seem to trend in the same direction as equity markets. As we've seen an uptick in the markets, we've seen more interest in high yield. Looking at the bottom, Lipper, so we have short investment grade debt, about $2.5 billion out. Loan participation funds, they've really continued to struggle, especially in the second half of the year, $1.7 billion out. Just kind of focusing on that, this was really kind of the big story when it came to flows in fixed income for the first half of the year. We saw about $23 billion come into this group. A lot of it, I thought, was on the idea of investors patting themselves against interest rate risk. I think once we got through halfway through the year and a lot of that concern subsided, they kind of took another look, and the second part of loan par is that they are supposed to give a little bit better yield, but they definitely were lagging against their high yield brethren. So a lot of investors since that point have been coming out with 1.7 out this quarter. For the second half, about negative $10 billion for the second half. So still positive for the year. Roughly about $13 billion in for the year, but again struggling through much of the second half. Looking at the mid group area, you might see some surprises, especially after we just talked about the performance. You see kind of the general U.S. Treasury funds, short U.S. Treasury funds, and with Treasury funds doing so well, it's been kind of interesting how we haven't seen really that correlation in flows throughout the year. In fact, when you look at general U.S. Treasury funds, only about $200 million in this quarter, despite the 1.25% positive performance, and even on the year, not much interest in these products. And again, I think a lot of bond investors, don't really look to these through mutual funds too much, but with 15.8% performance on the year, it seems that a lot of investors may have missed out because there hasn't been too much movement into this group. Moving on to municipal bond funds, last month last quarter they did quite well. Again, we attributed that to they've done quite well on their positive returns. They also have a view of relative safety now that a lot of investors are kind of getting over the spooks that they got towards the beginning of the year with Meredith Whitney and some other people coming out talking about possible defaults in municipalities. But again, we see positive returns for them, and investors are rewarding that by going into these products. They basically posted a $7.8 billion quarter. And if you look at it on a month-by-month basis, you see that the numbers continue to strengthen and continue to increase. $1.4 billion in October, $2.6 billion in November, and December 3.8 thus far. So a lot of interest continuing going into this group. I think we'll continue to see interest in this group going into the new year. But if you look at the year-to-date numbers, the flows are still negative, about $12 billion. And again, that's really kind of the struggle that they had at the beginning of the year. And I think they're going to look to turn that around going forward. The last group we're going to look at is money market funds. So up through October, really the story was net outflows in money market funds. Again, in October we saw about $24.5 billion go out. I think what it was is investors, even though they were on the fence, excuse me, about the risk in the market, it was really tough to put money into basically zero or negative yielding products. So I think they were looking outside of that towards higher quality, and possibly even some investors not even looking at money markets and going more towards high yield. But there seemed to be a turnaround in November. We saw $54.9 billion come into money markets in November. It looks like a little bit of risk reduction again. It could be putting some money away for year-end operations, but I think a lot of it was, when you look into the December numbers, it was continuation of investors kind of going to the sidelines with the uncertainty in the market and how the year was going to close out, and with no real answers on the European debt crisis. Into December, we saw $37.6 billion come in. And so if you look at November and December, we saw roughly about $92.5 billion. And this is the largest 2 months of inflows into money market funds since the end of '08, where we saw way over, I think it was somewhere around the $200 billion mark as investors fleed into money market funds. So before we go to the last slide, looking ahead, one thing that I did look at, and I apologize for not putting a slide up, was really kind of what kind of classifications, aside from what we went over, really did quite well in 2011. And if you're under the belief that we're going to see similar levels of volatility and some of the similar themes going into the new year, really what we saw for the top 5 perspective of where investors were putting their money were equity income. As we talked about before, they've garnered a lot of assets. They've been either investors have been flocking to that group, or I think there's been some intermediary pressure from advisors saying if you're going to stay into equities, you should go into these dividend payers, especially for the long term, and try to get some stability. Even though we've seen very much volatility, when you're looking at stocks on a capital appreciation stock price basis, at least you have some stability in dividends going forward, and a lot of investors think that's where people should be focusing anyway. Global income also did well, so it's going to be not only U.S. bonds, but funds that were diversified across the globe. Flexible groups did quite well. We had Flexible, which is the domestic group, and Global Flexible. And these are going to be funds where basically they're going to be multi-asset type, fixed income and bond, but also real estate, gold, things of that nature. And investors have really kind of been going to this direction for some time now, since 2008, as they look to products that may not be long only. They're going to be putting more faith in their advisor that's going to be able to then read the market and be able to position their portfolio in a better light than, say, some long only equity funds. And I think we still haven't seen that they've proved themselves outright with some of the fluctuations in the market, but these type of products have really gained some ground over the last couple of years. And the last is emerging market funds. As we mentioned, performance really hasn't been there, but investors continue to put assets in emerging markets. Again, I think with that forward-looking thought that once we get a little bit of closure on some of the concerns in the market, and as markets start to turn around, we see some positive growth, that those are really going to be the leading industries for that. So next we're going to go on to Sasha Fronger, and she's going to be talking to us about some target date funds.